Hi there, this is Steve Nimbisky again for GMTA Market Letter. We're going to take a macro technical look today at the S&P 500. That's basis the cash index using a monthly chart. This particular piece we called Hold On to Our Tutus. It was the second part of a piece that we had started earlier in the year. Anyways, we hope you enjoy it, and we'll move on to the chart now. This chart dates back to June of 87. You can see we rose up into the highs August 87 before we corrected very sharply, falling in the crash of 87 down into the October lows. We lost about 36% top to bottom, and that move ended up about 216 and a half level at that time in October. From there, we started a fairly nice gradual ascent up into the mid 1990s. Then we accelerated up into the March 2000 internet bubble highs. We reached a level of 1553 that represented a 617.5% gain. From there, we fell down into October 2002. We lost about 44%, ending up around 768.5, and then proceeded to rally again up into the October 2007 highs, reaching a level this time of 1576, and that represented about 105% return. From there, we then fell into the financial crisis market lows. We lost 57.5% roughly, ended up about 667 at the lows in March 09. From there, we started to rise quite sharply, given the amount of money that was flooded into the system by the central banks throughout the world. We termed this first channel up the new uptrend channel off of the March 09 lows. You can see in October 2011 we started to accelerate up in another channel a little bit more sharply, actually having broken out recently out of the original new uptrend channel from 09. What we want to look at on this chart is this large corrective consolidation pattern that we feel started in March 2000, the internet bubble highs, the upper boundary traveling through October of 2007 highs right through till now, the lower boundary from the October 2002 low through the March 2009 lows. This particular pattern is a continuation pattern, so if you can sort of imagine the direction into the pattern, we would anticipate that we'll continue out in the same direction from this pattern, which we appear to be doing now, actually, kind of validating that particular interpretation. The pattern itself, you can see from the March 2000 highs, we cracked down, in a typical sort of A leg, back up into a B leg, and down again into a C leg, and then before we start the next uptrend to resume the overall long-term uptrend. Now, these patterns can be used to generate projections, and the projections are generated on kind of the consecutive in this case monthly breakouts that have occurred through the upper boundary of the pattern. Over here we've kind of highlighted the projections that have been generated. This megaphone pattern generated a projection up to 2508, which is a little bit beyond what most people are currently anticipating, particularly on this run. The thing one has to keep in mind with these macro type projections, they can take quite a long time to unfold. So you could see a lengthy consolidation correction even develop, provided we don't start closing back inside the pattern itself. Then the projection remains valid, and even if it is negated sometimes on a shorter term basis, it can be regenerated again on further breakouts again from the pattern. We're highlighting as well this macro uptrend channel that starts from 87 lows and goes through the March 09 lows, and then the upper boundary from the March 2000 highs up through current times. That pattern itself, again, could be used to generate a projection, and since we've had multiple closes again on the top side of the pattern up here, that projection has generated a range of 27.59 up to 31.82, call it. We don't think that projection has much chance of being hit right off the bat here, mainly because we're going to have to go straight up parabolic wise, and I think if we see that happen, the Fed is going to start to ramp up rates fairly quickly. I think they'll realize that things are starting to get out of hand on them. So my suspicion is that given where I think we are currently, we're more likely to negate that macro uptrend channel projection, the extended range up there, and end up kind of validating the megaphone pattern. So I would expect that we could see us correcting back down to the top of this pattern at some point, and hopefully staying above it to validate the pattern before heading back out of it again. At that point, we will generate an even higher projection because the upper boundary of the macro uptrend channel will be at a higher level. So when we start closing over there, we'll get an even higher target projection generated again out of that particular pattern. You can see right now, one of the reasons I think we're going to go into this correction consolidation is that if one looks at these indicators down in the second, third panels of the chart, we're literally traveling at maximum overbought levels on both indicators. This top one here is an oscillator. We use a 10 to 30 month and a 20-60 month, very long-term work here. But what we're looking at again primarily are the crossover points, particularly on the downside and the upside for our bottom work. These are going to lag somewhat. They're not the most sensitive indicators, but they're great for kind of getting the overall trending. They can actually cross quite a bit ahead of time before one sees the final highs or lows, but it just puts you on alert that we're getting closer to perhaps some sort of turn point here. Anyways, where we are right now, if we look in this area and here, we're still maintaining a positive spread with the red shorter period one above the longer 2060 period one. That spread, as long as it's positive, and you can see that we're still trending somewhat moderately higher here on the longer 2060 indicator. The red 1030 has started to round over a little bit, maybe starting some sort of topping out process here. So we're at a point now where one has to start being quite cautious in their amount of exposure here, and probably should consider taking some off the table at this juncture. You don't want to remove core positions because we just might head straight up in parabolic fashion to some of these higher projection, and particularly the megaphone projection, which might have a shot at coming in at 2508 area. Anyways, the stochastic itself, as you can see, we use a 21 bar, and again, it's right at maximum overbought levels. It's still retaining a minor upcross here, but it has started to flatten out itself, and it can't really move a lot higher. This is a finite measure. It doesn't move higher. The oscillators here actually can push up into new maximum high ground before they roll over and down, but we're pretty well reaching the upper limits on this stochastic measure, and one of your first indications will be when this crosses to the downside. Your confirmation will come when you see a cross down on the longer oscillators up here. That will be your signal that maybe we're starting that lengthy correction consolidation period. So now is not the time to be overexposed in our estimation. I don't think you want to be using leverage to any extent here, frankly, and my tendency here would be to raise cash on further strength, keeping of course your core positions, maybe adding back a little bit if you sell some into some strength, adding back when we've had a good stiff pullback. If we pull back in particular, ideally to this top of this macro megaphone upper boundary here, that would be, to me, might be a time to start to really look more aggressively at adding to positions. Anyways, that's the way we see it right now. Thank you again for joining us. This is Steve Dambisky for GMTA Market Letter. We'll talk again in the not too distant future. Thank you again.